Hello and welcome to another episode of Finsec podcast. We call it Decoding with Finsec. Today's special day for us. We have our guest Vishal Dhawan. Uh, People in the finance industry knows him very well. He is a certified financial planner. He runs one of the premier investment advisory firm, which is called Plan Ahead Wealth Advisors. He's won many awards as the best investment advisor. He has been director of RIA, ARIA, which is the industry body for investment advisors registered with SEBI and also of Network FP. He's also been a client of a long-term association with us, and all I can say is that he's a thought leader in the business of financial planning and investment advisory. Very warm welcome to you. Thank you so much for accepting the invitation.
Thank you so much for having me over. Looking forward to this conversation.
So we'll just start straight to the topic, not wasting everyone's time. So we're going to discuss about what we do in financial planning. What is financial planning? Because a lot of discussions have happened in the sense as to financial planning means taking care of individuals throughout the life journey as to how they go about their financial wherewithal. Also, in terms of regulatory architecture around it, as to how SEBI in 2013 came up with a SEBI registration for investment advisors. You, as your entity, is registered with SEBI as an investment advisor. For the viewers, can you please explain as to what exactly is financial planning? How do you help your clients? Are these clients are like 25-year-olds who come and make the new money, have make 20 lakhs of a month, a year, maybe not having more savings, but in the process of saving money, or it's people who have already made some wealth, like 35, have some disposable asset like 50 lakhs, 1 crore, 2 crore, 5 crore, and then they come to know, how do I plan my future? How do I save my money? How do I go about life? So what's your day-to-day life as to what do you do when somebody says that I do financial planning?
So I think it's a great question. It's a term which is sort of used and misused very commonly. And this is a challenge not just in India but across the globe. That the definition of financial planning itself varies. Of course, in the SEBI regulation for investment advisors, financial planning has got defined. But I'll try to talk about it more from a landscape perspective in terms of what people do when they come to us. So if you look at any client or client family, there are few areas that they tend to focus their energy on when they reach out to someone to take care of their money. The most common is their investment portfolio. And therefore, all the conversation is about various assets that they own, whether it is something to do with the stock market, either directly through equity or through mutual funds or through PMSs, or it's bonds or debt mutual funds or gold assets, real estate, etc. But I think the financial planner typically is actually looking at things from one level above that, trying to say that, okay, what are the kind of things that are going to influence the life of that family and what is important to them to achieve as far as success is concerned from their money life. So the starting point tends to be to look at the income streams. There could be money coming from salary, there could be money coming from bonuses, there could be ESOP compensation that is coming in, there could be rental income that's coming in, there could be royalty coming in because they've got a trademark or they've written a book or something of that kind. So one part to look at very carefully is the income side, and of course the income also is got tax elements to it because what you see on CTC may not actually be what you get in your account every month. You then move to the expense side, and I think as people get wealthier, one of the things that we see very commonly is people don't know how much they actually spend, and they either don't care, which is a smaller number, or they feel very guilty every time they spend. And sometimes they hold back from spending because they just feel like, I think I'm spending too much.
I can't afford it.
I can't afford it. And actually, they could well afford, three times that expense, but they just don't know it. The third thing is liabilities that they may have. So they could be home loans, they could be car loans, they could be education loans for their children, there could be debt you're running on your credit card, there could be ESOP funding that you're doing. So there is a liability side to many balance sheets for individuals and families as well. And last but not the least is the financial goal side, where someone needs to help people define what is important to them as a family. Very often when people come to us and they start talking about financial planning, a lot of the goals that we hear from them are goals that their ecosystem talks about. So, I want to send my children to study overseas. Marriage should be nice. My house should be in a particular geography. I want to travel every year, internationally twice, maybe 3 domestic holidays. So I think a lot of that conversation is great because it helps, first of all, to define what you want your money to do for you so that it can satisfy your objectives in life. And then, of course, there are deeper things that people talk about, saying, a lot of people who are salaried want to become an entrepreneur someday. A lot of people who have enough want to give back more to society. So there could be different elements that also emerge there, which need to get taken care of through the money that they have. And very often, people need to prioritize what's important for them because maybe they can't do everything they want to do, but they want someone to help them understand what can I do versus what's the trade-off. Let's say uh, very commonly people come to us and say, I'm just feeling burnt out, and in today's world it's very common. So can I take a sabbatical, or can my spouse take a sabbatical for a
Or
year?
fire is also
Or fire is a big thing,
yeah,
absolutely. Fire is such a big revolution globally. And someone has to do the numbers, and that answer won't come by answering, which stock should I buy,
correct.
or which mutual fund is good, or which PMS is the right option. I think it requires a very holistic approach to be taken, which is what financial planners do globally, to sit down with the family, have these conversations, run them through structures, processes, tools that enable some of this conversation to happen. And then the investment strategy, which is originally where many of them came to you from, emerges from all of these pieces together. And therefore, it's a co-created sort of financial plan uh, to which there is ownership. And then, of course, you need to go back to this every year, at every predefined frequency, see what's changed, what's not, etc. Because there are so many assumptions, as you can imagine, built into all of this. Inflation, you could be assuming 8%, actual inflation could be 6 or 4. Rupee depreciation, and there are so many such pieces. So what the financial planner really does in a day-to-day role, like someone like me, is essentially look at all these variables and try to put it together so that people have a structure, they have confidence about what they're doing, and they spend right and they invest right, both in the process.
So how do you see whether from a point of view of, like, say, a salaried person or somebody who's an industrialist or businessman or trader, or not a trader in the market, but like has a shop or something. So is there a rule where you see, because income stream from a salary is consistent but unpredictable, that you can lose a job, as opposed to like a business guy whose income every month can be predictable, but at least has a shop that he can go to every make some money, if not good money. So, is there a, how do you see more people who are salaried come to you, more people with business background? Is it a mix of both, or is it people who salaried class are more uh, intrigued as to what's my future looks like, and business guys that take care of themselves? Is there insight that you can give in the sense of how, what kind of people do come to you?
So I think sometimes the best way to answer this is to say which kind of people don't come to us.
Okay.
Right? So we find that when people are starting off in their career very early on, they're just happy to save money,
Yeah.
and invest it somewhere. They're not necessarily focused on financial goals. Their goal is really just
Yeah. Make some money,
ensuring that
spend
I
it.
don't spend it and save it somewhere. Uh, and therefore, we see that typically happening for a lot of people up to the age group of maybe 25 to 30, where just the freedom that income has given them means that they save a part of their money and they're good. Uh, Once they cross some of those phases, they start to settle down, they start to look at their careers differently, etc. Then they start to look at financial planning much more because the trade-offs start to become apparent. Let's say, I think I'm missing a master's degree,
Mhm.
and I think that's going to help me do better in my profession. But can I afford to do it? Can I afford to take a sabbatical? What's this implication going to be for me over a period of time? So they start to talk about it. Even with business owners, there are always questions coming up saying that, I have my own personal financial goals that I want to achieve, and then there are business objectives.
Correct.
And most of these very often are interlinked. And the way tax laws, for example, are structured is you cannot take out money from your business
Correct.
at your will.
Yeah.
Uh,
Different
anyway,
tax
I
and
mean, you have
yeah,
other
yeah,
taxes,
cap,
etc., to deal
everything.
with. So you need thought process in terms of how you make this happen. and very often, you need to start to say that, okay, I need to plan for this in advance. I can't just, wake up one morning and say, my son has decided to study in the US, and I have a great business, but I still need to support that expense, and it has to come from, my LRS provision and all of that. Uh, Even if you're a trader, right? At the end of the day, the the reality around traders, and I think they've figured this out in the more recent past very clearly, is you can have a tariff suddenly put up, and your entire business and your entire trading model can get disrupted because your supply chain now doesn't cater to what you were thinking it would cater to.
Yeah.
So I think each of these people have their own needs for financial planning differently. And a large part of a financial planning piece is also to think about risk management. Because what happens is there's a plan A, right? Everything goes as per plan. You retire at 60, you run your business till 70, you find a succession plan, you do your trading, you do all of that. But there are plan Bs which happen. Someone loses a job, someone passes away young, has a medical issue as a result of which he can't run his business in the way that he could because he needs to slow down. So there are so many such situations that also emerge. And therefore, one of the important parts about financial planning is to say, let's plan for plan A, but let's also plan for plan B, and then try to figure out how we continue to do this journey in a manner where we optimize it along the way, because a lot of this will not be clear. Now, whether you get a regular income or you get your income every quarter, or you get your income annually, or you sort of plan for it in any other way. I think those are the mechanics of how your income is coming in. It's like your expenses, right? Some of your expenses happen monthly. Your school fees may happen once in 6 months, once in a year. So I think that same mechanism works here as well.
So what I got from your answer is that you don't advise only on what investments you're doing. You talked about tax, you talked about insurance, maybe health insurance, maybe life insurance. So of course, investing, if you have some surplus money, you'll advise them invest in mutual funds or stocks, or for that matter, gold or any other asset class, or bank FD, of course. So now, SEBI registration as an RIA, registered investment advisor, came only in 2013. Before that, also you were doing your business, and there are other financial planners also doing this. So now SEBI, now that has come up with a registration with RIA, which deals only with securities. So how has this? You are one of the first ones to get registered. You led the board of ARIA, so you're part of this whole SEBI registered investment advisor, which is, I understand, is only one piece of what the entire thing that you do. Although financial planning is termed as one of the defined term of under the investment advisor regulation, but it's not. SEBI does not cover the entire industry of financial planning; it only covers a part of it. So, from your perspective, as both as an entrepreneur, as a financial certified financial planner yourself, and being a part of the ARIA board, where you've seen the how SEBI has shaped up this registered investment advisor outlook, how do you see whether this has helped your organization, your business industry as such, or has it actually created some impediments vis-a-vis what other services that you offer currently, which was prior to the regulations as well?
So I think it's been a journey for sure. So I'm just going to go back and rewind a little bit over the years, right? So if you go back to the pre-IA regulation era, there was no concept of an investment advice at all. Everyone distributed a financial product.
Correct.
And they could choose to get the revenue in the way that they felt it was appropriate as a business. So a lot of people who are investment advisors who set up their businesses maybe 20 years ago, 25 years ago, etc., like us, started off with doing financial planning, but our revenue source was very often the distribution of the financial product.
So no money taken directly from the client.
Yeah, there was some money. I mean, again, it was a journey, but that journey was also sort of disrupted at that point because there used to be a concept of entry load, as you would remember, in mutual funds, which went away in 2009. Yeah. And at that point, a lot of people like us, we moved to charging a fee because that revenue
was gone.
went away.
Yeah.
So typically what happened is 2013 actually finally created a fiduciary setup, registered and recognized by a regulator, saying that here's a group of people who can potentially do two things for you. One is give you multi-product advice, and the second is be able to charge in the way that they feel appropriate for their services. So I think the big thing that the regulation did was created a separate new profession, which I think the regulators need credit for, because till then there was no way to differentiate. Like many other professions, when they start off, there is confusion, etc. But the good thing was that the profession, the start of the profession coincided with the introduction of direct plans and mutual funds.
Correct.
And therefore, there was an ability to actually go out and talk to investors saying that here's the equivalent of a different share class that you can take access to, where the expenses itself are going to be lower on the mutual fund. And instead, you're compensating your advisor through a fee. Now, of course, your advisor is doing much more than just mutual funds.
Correct.
He may be doing the entire gamut of financial planning, like we discussed, but clearly, the whole idea around this was to get uh, investors used to paying a fee. Now, that regulation underwent a significant change in 2021.
Yeah.
And a lot of the learnings from that period of 2013 to 2020 got applied in that regulation. However, we do believe that that regulation that came in sort of was so tight that it may have held back the growth of the profession for a while, because it was very highly prescriptive in terms of what was to be done and what was not. And one of the things around the IA license itself is there's been no one single business model that has got that license in place.
Correct.
So there were people who were doing only equity advisory, for example, who may have taken an IA license. There could have been people like us who were financial planners who had taken the license, and therefore the same regulation interpreted by a financial planning firm like us versus a stock advisor,
tipper, like giving stock
or
tips,
someone giving stock tips, was dramatically different. And therefore, again, to SEBI's credit, a lot of work happened between 21 and 24, and the new regulations came in the latter part of 24.
Yeah.
And what has then happened is that you've now got a much better framework within which things can be done. You've seen a lot of relaxation happen. You've seen net worth requirements getting replaced by deposit requirements. You've seen
Advance fee, one advance fee. Yeah.
changes. You've seen one of the biggest risks for financial advisors who were IAs was you had to clear your 10A 10B exam every 3 years, which is not common to see in across professions, that you have to sort of, you can't do continuous education, but you have to give an exam.
Only 1,300 people in the industry had to give multiple times.
And
not everybody.
Yes, and the success rate, the pass rate on that exam was not the highest.
Yeah.
So you now have, of course, a 10C exam that's much more easier. There are, for people who are just coming to the industry, they still need to do 10A, 10B, but that's a one-time thing now.
Yeah.
And then you get to other things. So I think a lot has changed in the industry over this period of time. And we think that many of these steps will help growth happen. But there continue to be some challenges that, probably prevent acceleration of this growth. And clearly one of the things around that has been the fact that multi-product advice hasn't got its due attention. The good news has been that in the most recent regulation, and then subsequently some clarifications got issued, IAs are now allowed to give multi-product advice across regulators as well.
Correct.
But there is a disclaimer to be taken from the client.
SEBI is not responsible for
this. And I think while that has its own advantages for the regulator, I think from an investor's perspective, it does create a little bit of a concern, saying that, is my quality of advice really going to be the same for investment products
which I have license
versus other products? And therefore, there may be a need for a bit of a rethink on this in terms of whether a unified regulator or a unified license might actually be the answer to some of this from a process and a thought perspective, so that the investor feels confident that the person they are dealing with
is qualified
and meets criteria across places. Of course, this is much better than not being allowed to do it at all, which was actually where the original regulation
Yeah, you
sort
have to
of seemed
segregate and do the business
yes, that was
separately.
much
Yeah.
more complex. I think this is a much better thing. I think it's also much better for the investor, because the investor, especially if he's looking at a financial planner who's looking at things from a top level, the investor wants all these answers. He doesn't, let's say a very simple question. It comes to us so often that I have a loan and I have some money. Should I invest it or should I pay it off? I mean,
Hmm.
it's a very
Normal
fundamental
question.
basic
Yeah.
question. Now, if you are allowed to advise on both sides of the balance sheet,
Yeah.
you can give that advice. But if you're allowed to advise only on investments, but not allowed to give loan advisory, because that is regulated by someone
Yeah.
else.
RBI regulates the FDs and the loans, and SEBI regulates the investments. Yeah.
That's right. So then you have this mismatch, because the client's balance sheet may look distorted because the regulations are trying to segregate assets and liabilities from each other in a different manner from what the investor is trying to do. And therefore, I think this step of at least allowing disclosure and getting the client to sort of agree that there's no recourse to the regulator if there's advice which goes wrong is better than not having that option at all. But clearly, I think it needs one level above thinking, saying that we need a license where people, they need to meet qualifications, they need to obviously be of a high enough quality to do it. But I think that's where real growth will come from, because people will then start to look at financial planners and investment advisors who do holistic advice, saying that okay, this is really a one-stop shop for me, where I can get my entire uh, wealth managed in a manner where all the pieces are covered rather than just my investment piece.
That is where I think even the regulations are supported. If you see the regulations, SEBI investment advisors, if you see the mushrooming of the new fintech industry is also focused on this short-term goal-based investments. Let's say if for an investment, rather, there are people who do stock tips, who do this, buy this at this price, sell at that price, or whatever, from the point of view of making an investment, short-term investments. Plus then you have all those modern portfolios, the small cases of the world, where they will advise on a curated set of stocks, for let's say EV stocks or ESG stocks, which are people just investing that amount of whatever surplus amount of money, and then you're looking for avenue to invest. Where should I invest? These are the avenues to invest, and advisors are giving you that advice for a specific amount of money that you have surplus money you can invest. But the regulations are also geared towards protecting that set of people. There's no regulations have not been framed for people like you who are doing wholesome financial planning, wherein the entire gamut of your client is a client for life, that you're handling the client right from the beginning as to how do you invest, kicker or liability, your debt side, your asset side, plus your in the sense of insurance and taxes and even bills and everything else, your future gift and succession. So from that point of view, is as you correctly mentioned also, that there is SEBI. See, one thing is that we can think about a solution where IRDA, PFRDA, RBI, SEBI comes together, comes with a unified license. That this is a financial planner who is registered, who can give advice on all these objects, all these aspects, as opposed to sitting on only SEBI having one more, RBI having, then how could do you marry each of these separate? Because and when for an investor, investment is everything, in the sense they will not ask you for gold, I will go to somebody else, for FD I will go to somebody else, for real estate I'll go to somebody else. You want one, like it's like a family doctor. Family doctor is a family doctor. You call him or her first thing, and then you go to experts. Even for you, like you, people will come to you, say where which PMS should I invest. You will suggest the SEBI registered intermediary itself, a PMS guy. So from that point of view, you become the family director, family planning guy, not family planning, a financial planning guy.
Right.
So from that point of view, I'm saying, how do you see, in the sense, where do regulations go? In the sense, if in this investment advisor regulations also create a separate framework for true blood financial planners, wherein you create a certain framework, people who are not doing this stock tipping and blah blah, who are creating financial plans, should follow a separate framework, and these people who are doing this fintech goal based planning or creating those small cases kind of a thing, uh, do you think there's separate regulations within SEBI framework itself, or we have some laudatory goal that let's get all the regulators together, and then that will take 5 years, I think.
Yeah, yeah. So I think there are two, three parts to this, right? I think there are things that regulators can do, like SEBI, right away to make this a little easier. And I think there are some international practices that one can think about here. Um, let's take the SEC for example, right? The type of regulation that happens varies depending on the size of the advisor. Um, the SEC, for example, has only regulates either international advisors or it regulates people who have a minimum size of assets under advice. While there is state level regulation that comes in case people have smaller sort of assets under advice. So I think a single untiered investment advisor license creates its own limitations because in this industry, in those um, 1,000 odd investment advisors, there is a very large number of individual advisors, and they have to deal with the same level or similar levels of regulation as firms which are larger. So I think one of the things that would make a large difference is being able to think this through, saying, how do I classify investment advisors differently? Now, whether that's going to happen by number of clients, assets under advice, revenue, I mean, those are all things that could be thought through in terms of process. The second is that there are certain restrictions that come in when you want to give holistic advice. A very simple example is that if there is a distributed asset which already exists, which someone has distributed earlier, when you give advice on that asset, you're not allowed to charge a fee.
Correct. Like AIFs,
And
very clearly.
and this is, if you just think about a professional service, let's say a doctor, because you just gave that example. Let's say nothing prevents a patient from going to another doctor and taking a second opinion just because that payment has happened to another doctor who maybe the patient is not comfortable with, or maybe just wants a second opinion, uh, should not prevent the second doctor from charging a fee.
Correct.
But that's actually what the regulation is doing today. And we think it's a limitation. So either what you have to do is you have to create a framework within which these assets can be moved to direct plans without a tax on them. Because what ends up happening is if the investor is going to have to pay a tax to move from a regular plan to a direct plan, whether it's a mutual fund or any other instrument, there is going to be resistance. And in fact, even as an advisor, you might hold back saying that, why would you take so much tax burden because of just this reason? So I think there are there's a precedent in this. When scheme mergers happen, there is already a provision that the original cost can be taken in. So there's no tax loss to the government, but it makes it easy for the investor to actually go and get the right kind of advice.
I don't think it's tax issue. I don't think at all is tax issue. It is a huge AMC industry issue. The industry and distributors are agents of industry. The moment you allow distributor assets, regular plans to move into direct plans without a tax impact, it's a huge shift going to happen. I've been sitting on so many regular plans assets which I didn't know better in life, but I can't shift because I don't want to pay tax on it. And there'll be a lot of people who just want to move to direct plans, and this distributor is going to lose a lot of money because once you move that thing to only trail commission, that's the only benefit that they have as long as they're invested. The moment you take that away, investment advisors will be the happiest people, distributors will be the worst off. So that is a huge, that's a fight. I don't think it is a tax issue at all, because tax wise, I have to sell, I'll sell anytime. It's not about, and from a fixed or from AMC point also, they're still making the management fee. Their loss is not there. And it's not that I'm using any other scheme. Same scheme, I'm moving from regular to direct.
That's correct. So it's very much an investor interest.
Yeah,
well, right?
of course.
So in fact, it's a good example of where I think some of these, what should I say, regulatory arbitrage in different ways plays out. We talk about financial planning, right? Now, because of the way the regulation is framed, where you can do goal-based planning without consideration, because the regulation states that financial planning means doing it for a consideration.
Correct.
You could be a distributor and continue to do financial planning because you're not charging a fee for it, and you're compensating it through the commissions that you end up getting. While if you're an investment advisor, you would charge for the fee. You would charge a fee for the financial planning, and the investor actually on the other side is saying, hey, I get this service free from someone else, but I have to pay you a fee for the same service. Right. And I think these are the kind of regulatory gaps that need to get plugged, because I think there's a very strong need for people to understand that if you need to do robust financial planning, it needs a lot of time spent on it. Just imagine putting the income asset,
Absolutely, yeah.
liability, expense piece together, financial goals, doing life planning, doing all of that. So there has to be a good method for the time spent to be compensated. You're a professional yourself, and time
Yeah,
needs to get compensated.
yeah.
So I think some of these gaps need to sort of get plugged for this to happen. I think to your question again, coming back to this whole giving multi-product advice, and how does this can it happen in any other way, right? I think there are multiple ways to think about this. I think the if you put the investor at the center of this process, he or she is clear that they need it. They're always looking for it. In fact, they struggle with hearing three people give them three different pieces of advice, and very often because they're confused, they now go back to asking family members and friends and neighbors what they're doing, which is exactly what you don't want to do. You
Yeah.
can't be running your your financial life on the basis of what your neighbor is choosing to do, or some other friend is choosing to do. So I think the answer to this lies in saying that yes, I think there's a big requirement at the top level, which is essentially unified license. But even if that is going to take its own time, uh, don't make it difficult for investors to make this decision by asking them to sign off saying that I don't have a
I hear you on that, yeah,
sort of
because at least see the problem with SEBI has always been is that they don't want people to knock at their door when they don't regulate the product, and that is the whole pitch of this investment advisor, research analyst regulation. Why where issues have been stuck is because people, what happens is, let's say you advise on gold and loan and something, and gold and get shocked. People lose money in that. They complain that, see, I never asked for gold. These people advise me on gold. So from that point of view, regulator wants to wash your hands off because I don't ask me for that. So problem in that is that I think from a point of view of a regulator, you should encourage people to, once you have a license, there is no requirement to get any license to advise on gold on FD products. There is no license requirement. So we can have a better alternative that there is no license required. SEBI does not administer. The kind of disclaimer also they've put, it's just very, very sounds that people who are reading this and think, oh my God, have I come to the right person or not? So
yeah, I think it also maybe if you think about it from an investor's point of view, right, it also um, makes the investor worry that is he not capable of making his own decisions. Because I think in most other places, consumers make their own choice in terms of what is there, and there are safeguards which are built in to protect them in some form. Uh, so I think one of the things that happens with some of this kind of regulation is it assumes that the investor himself or herself doesn't know what is good for him or her, and very often the investor does know what is good for him or her. He or she may be falling prey to either greed or fear at two ends. And I think that's where an investment advisor really comes in and handholds the investor from both these extremes. And I think that's where, a lot of what the new SEBI chairperson has also been talking about is saying that, we need to be mindful of not being over prescriptive as well.
yeah,
Because what could end up happening is the more you prescribe in terms of only one way forward, I think the more likely that there are sort of side effects and
yeah, absolutely
level
that.
to impacts that take place automatically. And I think in this industry, probably overregulation has prevented growth. I think there's one more big piece that really this industry needs to grow, which is um the need to help investors understand different types of intermediaries well. I think today there is no place that a person can go to figure out that okay, what is really a difference between a distributor and investment advisor, research analyst.
Lawyers like us.
So someone has to go out there and communicate to the investor that there are these sort of for this kind of advice, this is the right kind of intermediary to go to. And what ends up happening is if you don't do that, the person could be taking the wrong advice from the wrong person. Let's say if you have a challenge with your knee, right? In all probability, you know that you have to go to an orthopedic specialist, right? Now, there is no harm in my view that a regulator goes out and says that each of these people play certain roles in your life, and it doesn't make one better than the other. It just clearly defines roles, and therefore what ends up happening is, for the investor, it now becomes easy to understand that, okay, if this is what I'm seeking, I go to an investment advisor. Let's say I'm seeking holistic financial planning, I go there. If I'm seeking what to buy as a mutual fund, for example, I need to go to a mutual fund distributor. If I seek to identify, you know, 2 3 good stock ideas at an overall level, maybe I go to research analyst. So I think it really would help considerably the investor if there is a large marketing campaign that a regulator puts out, not promoting one type of intermediary, but really the fact that all these intermediaries exist, and how do you as an investor decide which type of intermediary is right for you. Someone has to play that role, and I don't think even a law firm will be able to do
No, no,
that.
no, no. I don't think. I think as in, I was jokingly saying for the
Right,
product, whom do you ask? I say you ask a
right,
lawyer.
right, right.
So I'm saying from I see the point in from SEBI point of view. They opened their Twitter X account a month back. They've been lacking in doing investor awareness of their own, as in the kind of misinformation is around. The right information, at least you have a source of giving right information, people go and check the right information. That part is still lacking. It's from a SEBI point of view. I think the new chair will take care of this, because people have raised this issue before the previous chair as well, as to what are we doing for investor awareness. The chair said no, we are not spending money on that. But you see RBI every day, if I watch IPL, there are ads on what to not to fall prey on. Even for the phone calls now we made in Maharashtra, you get a call saying that don't fall for the cyber crimes, etc. There's a large campaign to say that, at least educate. See, people, as a government body, as a statutory body, what you can do is do some kind of awareness campaign, and people will still fall prey. At least you can minimize the risk. Can never go away. People will get fooled. People, some cheaters will be there who will always do cheating. But at least if you more and more you do awareness campaign, people will understand. Some people, the right people, at least know about it, a word of it, will understand. So that is where I think the one more push is required, as you correctly said, as to how each of the different, what does a broker do, what does a mutual fund distributor do, what kind of what an RA does, what an IA does. Even for me, I still sometimes confuse what is an RA activity, what an IA activity is. When a client asks me this particular question, like model portfolio, sometimes it was IA, now it's RA. People, both set of people do it, and it's not like the skill sets are different. Like you, if you're an IA, you can easily do RA. I'm not saying for you as in financial planning, but a lot of IN who do stock advisories and etc., they can still be RA. So I'm saying that what regulations have done is they've created so many silos within one industry. Let's say financial planning, in the sense that if somebody wants to know where to invest, they can go to either IA, they can go to RA also, they can go to a mutual fund distributor also. But for them, it's the same thing of investing money. But people don't understand as to where should I go for what. That's why I think even for, I think IA is the bedrock of what actually what we should, what as SEBI as an organization, which is statutory organization given by Parliament, which is taking care of the interest of the investors. That is a designated body. So from their point of view, they should create a framework for investment advisors where people can come and take advice. And I think if you see merchant banker, they have to category one, category three. If you're running IPOs, you do separate one. If you're doing valuation, you do separate one. Even for IAs, they could easily segregate the different set of businesses. You can take all three, you can take one, two, three, separate rules apply for one, two, and three. I think that will take, of course, with that awareness campaigns, etc., as to go with an advisor only. If you're licensed, then only you take the advice. Otherwise, what will happen is the Finfluencer thing. That is the next thing that I want to talk about. When people do not have access, do not want to pay, like uh, uh, one suggestion or strong suggestion that we've heard in the market as to why from 2013 to 2025, 12 years, we're still at 1300. Actually, the numbers have gone down. There are trends that people are giving up IA license because it's too onerous for them. They can't advertise. Wherein influencers papers, their photograph and with ads come on the front page of Times of India and ET kind of nationwide magazines, newspapers. So what is happening is that people are going towards influencers who don't charge them money. They listen to them. They get whatever their interest. We don't know what is the conflict of interest, but people just take advice from them and invest. And then a lot of people who have invested through that influencers, and therefore people want to pay is the reason. Is that easily accessible on Instagram? You can watch all this advice, as opposed to people like you who have to go to SEBI and get their ad approved, and then they'll put it up. And for them, there's nothing, there's no restriction where they can make money, how they can make money. The only restriction SEBI has now come up with is that you cannot charge from a market intermediary. That is nothing for them. They want more from YouTube than what these guys will pay. So how do you see as to where are we going in terms of IA pushing up more number of IAs and Finfluencers versus SEBI-registered intermediaries?
So I think it's actually a very big question, and I think all professions are battling with this, because let's say, even medical professions are now, you have this advice coming through um, influencers around medicine who are saying, this medicine is not good for you, and medical pharma firms have to battle that. So it's a common challenge, specifically with influencers. I think um, the it's a very fine line between financial education and customized advice, and it keeps getting more and more complex because there are different people who talk about it. Just for example, a couple of days ago, um, ASCII has given a clarification saying that if you are giving technical advice, then you can't be doing it through a influencer, because then you need an IA license. But if you're giving general advice, it is possible. Now, this definition of general versus technical gets fairly complicated. So I think it is a real challenge for everyone, including the regulator, because a lot of what may be happening around conflicts of interest, uh, the level of knowledge, experience, etc., that people who are influencers bring to the table, etc., does create its own complexity. But I think ultimately a lot of this will also get addressed through the awareness of investors coming through from the regulators, saying that is this what you're seeking for? For example, are you looking for an answer saying what is a mutual fund, because you don't know what a mutual fund is, rather than the answer to the question saying which is the best mutual fund, or is the best mutual fund right for me as an investor? I think if you're looking for any of those kind of answers, you have to go to a professional, because only a professional can answer that question for you. But if you want to know what is a mutual fund, maybe a general influencer comment telling you that mutual fund gets you certain benefits, etc., is a good approach. And I think the more um, you know the regulations are enforced in the right manner, I think the more likelihood that more and more influencers will either then go ahead and take the license and then sort of go out and do exactly what investment advisors are doing. I think there is a little bit of gap between intent and execution of a lot of what happens um, with many of these things. So uh, there is some action being taken against influencers. A lot of work is happening around reaching directly to social media platforms, trying to put things down, take things down, etc. But it's a very huge challenge, and therefore, unless the investor education moves hand in hand with this, it's not going to work, because uh, someone who's trying to beat the system is then going to try to figure out what else can I do to beat the system. Whereas an educated investor or an informed investor who's being told from a regulator that this is how you need to think about your money, this is the kind of intermediary you need to work for, go to an influencer only if you want generic advice, don't go for specific advice. I think that needs to go hand in hand for this to work. Otherwise, what may end up happening is that you simply plug one hole in a bucket and there's another hole which emerges from somewhere else. And sometimes the way some of these are plugged could actually mean that for investment advisors itself, it becomes more difficult to do their own business. Um, and I think that's the balance which needs to happen, because as you try to get after the bad guys or the guys who are not regulated,
You regulate
if
more.
you keep regulating the good guys more and more and more, you end up finding that exactly what you worried about starts to happen, which is the good guys start to say, why should I be in this system? I need to leave it and go elsewhere.
That's true.
And
And
I
that's
think
what is happening.
that's right.
So one more, let's last point on this. How do you respond to this whole Indian mentality, or at least that's what we've been told, that Indians don't like to pay for their services. They rather take distributed products, whether they inbuilt cash, whether they don't have to pay advisor from their pocket. And from the fact from IA industry also, then they say that I, as an advisor, my fee is capped. If I distribute the right product, the delta that I make, alpha that I make can be much higher. Why should I, as a mutual, if I'm an advisor, my fee is restricted, but for mutual fund distributor, the fees can be as much as the fund grows and keep growing. So how do you respond to that? Is there something tweaking that is you suggest there we should make? A, whether this whole adage is true that people don't want to pay. B, this whole fee limit, there should be some tweaking in the fee limit in terms of the regulations.
So first of all, I don't think this is an India only
Yeah.
reality. I think world over, um, you know, people would find it more difficult to pay a fee rather than pay through an embedded cost. So I think globally, this was something that I used to think about many years ago. And as I met more and more international advisors, I realized that their clients are also as hesitant to paying fee as Indians are. So I don't know if it's a specific India only reality. But I do think that there are a few things that need to happen here. So one is, if you look at advice internationally, it is possible for you to recover your fee on a disclosed basis from the investor's portfolio for the advice that you give.
Yeah.
Yes. And that is a very big thing, because writing out a separate check or doing a separate funds transfer, the pain of it is multiplied.
Yeah, of course.
And if the intent of this is disclosure to ensure that it's not hidden somewhere, not taken away, etc., there are clearly ways to make that happen, which is what is already happening in many other intermediary setups like PMS, etc., where you have to send the invoice, the money has to be collected accordingly, etc. So I think the ability for that money to get recovered from the investor's portfolio, instead of having the investor necessarily pay that out, is one very important piece. The second thing, which I do think is also a reality around how this industry sort of has a challenge, is that when investors pay fee, once upon a time they would have this fixed fee versus AUM based fee complication. There is already in the new regulations that has already been made
taken
open,
care of. Yeah,
right?
You can do
and
both.
what has happened is the fixed fee, of course, is still fairly low for the amount of work that happens, at just about capped at 151,000. But for investors, for advisors who are okay with an AUA fee, then the 2.5% cap is a healthy cap.
Yeah, healthy cap.
I think what the regulations have also done is tried to allow changes within the year itself now, which was a limitation earlier. So I think there are attempts being made to address this issue, but there still continue to be, like I said, the ability for you to collect that money from the investor's portfolio on one side, which needs to get looked at. And the second is that, for pre-distributed assets, those should be allowed as assets under advice if you are the person who's giving that advice.
Yeah, if it comes under your portfolio, you're advising on that matters.
Absolutely. And the client could sign off saying that I'm okay with it. And, whatever disclosures, sign-offs, etc., need to be taken can happen there. So that I think, for investment advisors, they're also investing right in their business, because I think a part of the growth for this profession will come from having enough role models in place for people to go out and say that, here's 1,000 really successful investment advisors in our country. And, those investment advisors have succeeded because they have invested back into their businesses. They have built very robust teams.
Yeah, make an IPO. I think you should be the first one to make an IPO. Like mutual fund distributors have gone ahead and made an IPO and now become AMCs on its own. That's classic definition as to how mutual fund distributors have succeeded in life. But I can't see parallelly how to IAs are growing, because you limit the income, as in it was challenged before the High Court, also Bombay High Court was just set aside since the writ petition was dismissed. But I have a big issue as to how this entire thing of fee capping for one business itself, and not for other business. If you see, everything can do anything. AI, if you can do any, take any money, how much ever you want, or at least for have at least a limit that if you're advising anybody above 50 lakhs, then it's bespoke. 1 crore, 5 crore, do whatever. I'm saying there has to be some kind of rationalization for people to make more money. As in India, if you're an advisor, then no, you cannot make too much of money. That's not good for you. I think that is,
Yeah,
I think,
there is a probably a need between the accredited investor. So
yeah,
either the accredited investor, levels need to be made more sort of India centric rather than being at global standards.
yeah,
And the processes around that have to be simplified, because just the numbers around AIs, for example, are a few hundreds in a country like ours.
yeah.
So there is clearly a need for some of this categorization to happen in some form. And I think also one of the things that is very useful in all of these cases, in our experience, has been FAQs from the regulator. I think if the FAQs cover many of these answers, I think it gives more clarity to businesses. They sort of invest right in the business because they have clarity. There needs to be continuity. There can't be changes happening ever so often because you sort of invest. And we can see what turmoil is there globally when you don't know what tariffs are going to come next, right? The same thing is something that every regulator probably needs to worry about, saying that if I have too much change happening all the time, then as a intermediary, as a business owner, or an entrepreneur, you're probably confused on what to do next. And therefore, you need a lot of conviction to just say that, yes, I will keep adapting every few days to a regulatory change. Or you might take the easier path, which is essentially say that, why don't I just give up my license and go somewhere else?
What an irony for an organization who plans finances can't plan their own finance. In the sense, how do I do my business? I'm in the business of planning future. Plan ahead is your name, and I can't plan ahead for myself. As in, that's the irony of it. I think we'll just close this thing by just asking you, uh, the, the new SEBI chair has come. New SEBI chair is very upbeat on the investment advisor piece. Oh, he's come on the record and said that we will ease of doing business will work on the IA bit, and we wouldn't want people to get more IA license and the industry to thrive. So, what would you, what as in we can communicate to him through this as to 2 3 things that we can do as to, and how do you see the future of the RIA industry in India?
So I think the big thing is, there is a need for scale to happen within the IA businesses. And I think one of the things that regulators may want to think about is how can you create scale through a very stable environment that is created, which gives visibility, saying that, okay, now these changes that have come in are largely going to be in this manner for the next few years. We understand there's a need to be dynamic. There could be things that are coming in, etc. But typically, I think when there are accidents, we need to be mindful that you can't throw the baby out with the bathwater, and that's the risk that you run. So I think stability of the future, a lot of investor education to help people understand what this difference is, and then unshackling where there are bottlenecks. For example, uh, we spoke earlier on about fee being charged from the portfolio. It's allowed globally for that to happen. Can we bring some of those best practices into India? Because as long as it's disclosed, it's fine. Or if there are pre-distributed assets, how can that be put into place? Or if there is money moving from a regular plan to a direct plan, and that's good for investors, then why would we not allow it? Or why would we not, as a regulator, want to take that up with the Ministry of Finance, saying that this is really in investors' interest. We are just using the same model as we've used for scheme mergers to solve this. So I think on one level, uh, there is no need for rethinking the entire regulation for this to happen. There has been a lot of progress that has already happened in the last few years. I think there are some gaps, though, which need to get addressed. And there is also the need for this investor education piece to go full throttle, because just by the SEBI chairperson saying that India needs more investment advisors, I think the investor is not listening to it. The investor will listen when someone educates him, saying, this is what an investment advisor does. So if you're seeking the following, please go to an investment advisor. If you're seeking the following, please go to an MFD, and avoid any sort of regulatory arbitrage, because I think this, financial planning without a fee is not in the
That's true.
regulation,
That's
but with
true.
a fee is with the regulation. I think these are things which
Even small things
prevent.
like crypto guys can get Ranveer Singh, Ayushman Khurrana for ad even admits, but I can't even speak. So point is that when the unregulated industry is left for free to do whatever they want to do, and the regulated industry can't even move an inch, and that's where the balance lies. And that's why people live. Why should I follow the law and make nothing, and rather than I just get outside the regulatory framework and do my business there? I think
Yeah,
that
which is actually not what any regulator would
good
want, right?
one.
The
Yeah,
regulator would want an industry to be regulated,
yeah,
to thrive on the regulation. The regulation actually, I've always found over the years that regulation actually makes businesses much better
yeah.
because it makes them more structured, more process driven, allows them to scale, do all of that thing. But I think if it becomes over regulation, and it's a very fine line, I think that's where the challenges emerge.
Okay, thank you, Vishal. Thank you for your wise and wisdom. I think the entire investment advice industry should learn from Vishal as to how to build an firm which is on the business of financial planning. And we thank you for coming to our show and look forward for another episode. Thank you very much.
Thank you so much.